All right, good evening. Let's get started. My name is Tyler. I'm the founder of Stock Scores. I'll be your host for tonight's webinar. To all of my fellow Canadians, hope you've enjoyed the long weekend. For our American friends here, of course, you'll have your long weekend next weekend, but markets were pretty quiet today. And of course, the Canadian markets were closed, and the U.S. markets had very little volume, not a lot of volatility. We'll talk a little bit about the markets at the end. So tonight's presentation is called How to Grow Your Retirement Portfolio. And I'm going to go through some of the thoughts or concepts that I think are important to understand if you're managing your own retirement portfolio. So the itinerary for tonight, we'll do a little introduction. I'll then talk about the Stock Scores investing concept. I'm going to teach you something about how I think it's best to measure performance and go in. This will lead us into this discussion of the economics of trading. I'll then walk you through the process for finding position trades. Those are the kind of things you would look for longer term trades, the kind of thing you'd put in your longer term portfolio, not day trading or swing trading, but the longer term stuff. We'll talk a little bit about the components of the Stock Scores approach to investing, how you can learn my approach to investing, and then at the end I'll take some of your stock questions, and I'm going to show you an important chart on the S&P 500 just to what to watch for in the next little while for the overall stock market. So should take us about an hour. Let's get right into it. As I said, my name's Tyler. I've been trading for about 26 years. I started when I was 19 years old with $3,000 in capital. Some of that I borrowed off of my credit card and turned it into basically my career, I guess. I've never really worked for anyone. In the finance industry, I taught myself how to trade after I left university, and I've been doing it ever since. I've developed a lot of different tools for trading, and I think my approach is pretty unique. It's quite simple. It doesn't require an understanding of fundamentals or finance. It's just looking at some real important concepts, which if you've taken some of the webinars from the past few weeks, you'll know what some of those concepts are, and I'll touch on them again tonight. About 16 years ago now, I developed an education program for others to learn my approach. I like to see people take control of their money. I think no one cares more about your money than you, and it's important to understand how the stock market works and what you can do to avoid bad stocks and focus in on stocks with good potential. And we'll do some scans with the Stock Scores Market Scan tool tonight to do that. To begin, I want to talk about the Stock Scores investing concept. Most stocks, most of the time, are not worth trading. The reason I say that is because most stocks, most of the time, don't outperform the market. And if you're happy with earning what the market earns, which is historically about 7 or 8% per year, then you're best to go out and buy a really low-cost indexed fund that does what the market does without a lot of management fees. And there's ETFs out there that do that. There's mutual funds out there that do that. If, however, you want to beat the market, so if you want to get better than the 7 or 8%, then you have to become something of a stock picker. And that requires understanding what is really the most important concept for why stocks beat the market. And the key to doing this is understanding that market-beating stocks tend to start their period of outperformance with abnormal activity. They'll trade abnormal volume. They'll make an abnormal price gain on a single day or over a week. And when they do that, they are telling you that there's something going on fundamentally with that company that has attracted the attention of investors. And it's typically the larger institutional investors who do their analysis, who have great resources, who have very knowledgeable people on staff to do the work required to find those stocks that have the potential to beat the market. And when they uncover some information that really justifies a stock going into a strong upward trend, they'll buy that stock aggressively and create the abnormal activity that I look for. Now, a few weeks ago, I did a webinar on this exact topic, and you can watch that webinar on my Stock Scores YouTube channel. So go to YouTube, do a search for Stock Scores. You can find it. I think it's called The Secret to Making Money in the Market or something like that, one of my recent webinars. And it talks about the importance of abnormal activity. Beyond that, however, and that's really the stock picking component, there's more to trading the market than just buying the right stock. You must also know how to manage risk, how to preserve your capital, how to exit at the right time, and how to overcome your emotions. And that's all of these things, when to buy, when to sell, managing risk, preserving capital, all of those things are something that are always evolving over time. It used to be that I managed risk with stop loss orders. Today I use those less and less because I find that high frequency trading tends to take out stops sort of maliciously before the market moves back into the trend that it was in. And so now I use a concept called stop on close. My point in saying this is that you have to not only have a good strategy and a good approach to the market, but you have to also always be learning. And I'm always updating little details about my strategies to try and make them better and to fit the market that we have at that time. All right, so that's the concept behind the StockScores approach to investing. But I want to just go through a real important logic statement here. Most market-beating stocks, I'm going to show you a couple of examples in a moment. Most market-beating stocks start their trends with abnormal activity. However, not all abnormal activity leads to big price moves. And so we need a way to differentiate between the good abnormal activity and the abnormal activity that we want to avoid. We want to combine this concept of abnormal activity with other analytical methods to trade the stocks with the best potential. Now, when I started StockScores back in 1999, I developed an algorithm to help us pinpoint the stocks that are worth avoiding and those that are worth considering. And this algorithm you can use on StockScores, it's all free to use, is based on a number of different market factors: price behavior, volume behavior, momentum, overbought, oversold, trading volume. All of those things are components of the StockScore calculation, and they're very useful for tonight's topic, which is investing. We don't use the StockScores when we are day trading or when we're swing trading because they're not meant for that time frame. They're built for the investing time frame. And so in tonight's webinar, I'm going to go through the 3 rules for using the StockScores to help you not only find good stocks but also avoid bad stocks. All right, so here's a stock that has done quite well over the relative short term. By short term, I mean the last 6 or 7, maybe almost 2 months, 6 or 7 weeks, that period when it went from about $5.50 to $6 and then up to today it closed just under $8. So it's made a 33% return in, let's call it 7 weeks. That's a market outperformer. Now, what I want everyone to notice at this point, and we'll elaborate on this in a minute, but there was abnormal price behavior here with abnormal volume, and our StockScores were in the right place. And I'll teach you these rules in just a moment. I just want to highlight that for now. This is another stock, a longer term trade. This stock, the last chart was a daily chart. You can see up here in the upper left, it was a 240-day daily chart. This chart is a weekly chart going back 3 years, so longer term. And on this chart, we also had abnormal behavior here, and we had abnormal behavior here. Now, statistically, we can define abnormal behavior. We've built some little math algorithms that look for that, and they're part of the StockScores calculation and part of what the StockScores website does. But you don't need the math to visually see that the volume on this day was higher than normal and on this day. And the price behavior here was much greater than what we would normally expect. And so the abnormal behavior stands out visually. Now, before I get into how to use the rules, I want to give you a little lesson on how I measure performance, because it's different than I think most people use. Most people will say, well, I made 21% in the market this year, or I did a trade and I made $3,000, hooray for me. When you measure performance, you must measure it in consideration of risk. Making $1,000 if your potential loss was $2,000 is really not a great trade. We want to judge our performance using reward to risk. If we make $1,000 by risking $200, we made a risk reward of $5. If we risk $2,000 to make $1,000, we've earned a risk reward of a half, 0.5. These should actually be flipped around. Okay, so this concept of risk reward is what we're going to use when we look at some of these trades today. Now, in the economics of investing, and this is something that I think most new investors or people managing their money on their own don't have an appreciation for, not because it's a difficult concept to understand, just because nobody's ever taught it to you. The economics of investing are such that we need to measure our success over a large number of trades. Now, what do most people do? They buy Valiant and it goes up 20% and they sell it and they think they're smart. And then a year later they buy Valiant and it goes down 80% and they think that, oh my gosh, I know nothing about the market. You can't judge your performance in the market over one or two trades. It needs to be judged over a large sample size. And if you're right on a few trades in a row, doesn't mean you're a market expert, although many people will fall into that trap. And if you're wrong a bunch of times in a row, doesn't mean you're an idiot. Sometimes it's just a matter of, the numbers working against you. If I trade and I historically say I expect to have a 70% accuracy rate, that means I'm going to make money 7 out of 10 times. That doesn't mean I can't lose 5 times in a row. It doesn't mean I can't make money 7 out of 7 in a row. Because really, when you judge your performance over a large number of trades out of 100 trades, that's when you start to get the laws of big numbers working in, and you can really get an accurate assessment of the economics of investing. So we're going to go into a little calculation here, which is something called expected value. Now, I want everyone to think about these numbers. Suppose that you trade, and you trade for a whole year, and you make 100 trades in the year, and those 100 trades, out of those 100 trades, 60 of them are losers. Okay, so you lose 60 times. 40 of your trades are winners. Your average loser has a loss of, on average, $500. And your average winner, over the course of all those trades, gains $1,500. Now, how much do you make or lose after 10 trades or after 100 trades? Doesn't matter. Just try and do that calculation. I'm going to show you in a moment. But I actually want you to think about how you would calculate how much money you make after 10 trades if 6 out of 10 times you make or lose money and 4 out of 10 you make money, and this is your average loss and this is your average profit. I'll just stall for a moment. All right, well, if 6 out of 10 times you make $500, or sorry, you lose $500, okay, so that's a negative. That means you've lost $3,000 on your losers out of 10 trades. And if 4 out of 10 times you make $1,500, that means on your profitable trades you make $6,000. After 10 trades you make $3,000, even though you're wrong more than you're right because you've been losing 60% of the time. That seems a little counterintuitive because we are taught through our education system that to be successful at something, you have to be right more than you're wrong. To get an A in school, you have to get, 85% on your tests on average. And if you get less than, say, 50%, you get an F, right? But this strategy is only right 40% of the time. In school, you get a big fat F, and yet in the stock market, you've made $3,000 after 10 trades. So I want to drive this point home. Making money in the market, doing well as an investor, has nothing to do with how often you are right or wrong. It has to do with how much you make when you are right versus how much you lose when you are wrong. And it's important to understand this concept, which is the concept of expected value. If 6 out of 10 times we make 3,000, 4 out of 10 we lose 3,000, 6 out of 10 we make 6,000, we still make $3,000 because our losses are small and our profits are bigger. And that's how you make money in the market. Controlling the size of your losses and letting your profits run. In fact, there's cliches that you might hear if you read books about trading or books about investing, and that is stop your losses and let your profits run. And that really comes down to the economics of investing. So out of 10 trades, I tend to find the following. I tend to find that I get 2 bigger winners where I've got reward for risk of 5 to 15. And then I get 4 to 5 losers. Sometimes it's only 3 to 4. Sometimes it's 5 or 6. But I tend to get a batch of small losers. And I also get some smaller winners. Now my small winners tend to balance out my small losers. Where I make all of my money is in the big winners that come along only about 20% of the time. So out of 10 trades, 8 out of 10 trades kind of balance each other out, and 2 out of 10 trades are where I make my profit. Now the key then is to make sure that you allow for the bigger winners to happen and you don't allow for big losers to happen. You want to always have small losers, not big losers, because otherwise it throws out the economics of investing. The small winners and losers should balance each other out. The key is to have the patience to ride the big winners. That is where the overall profit comes from. Okay, I have lots of small losers. I have a few small winners, but every once in a while, roughly 20% of the time, I get big winners that make it worthwhile, make my trading worthwhile. And that's a difficult thing for people to get their head around because we are programmed as from the time we're in school to be right all the time. And we think that we're doing something wrong if we are wrong more than we are right. Well, in the stock market, it doesn't work that way. The best investors, the best traders are not right more than they are wrong. All right. Now let's move along to how we are going to pick some stocks, because we're going to run through the process in a moment. Now, again, some of the webinars we've done in the past couple of weeks have looked at these concepts in more detail. Tonight, I'm going to go through the process, but we're not going to focus so much on how to pick stocks because I've done that already. I wanted to look more at this concept of expected value, the importance of risk management. Those are the concepts that you need to understand to do well as an investor. All right, so we want to look for stocks that are showing signs of investor excitement. We want to look for the abnormal activity in the market. And when we see that, we're looking for things like breakouts or break of trend, breaks from low volatility, breaks from optimism, which are rising bottoms on the chart. And we're going to use our stock scores indicators to help us do that. So what are the stock scores 3 rules? And again, this is just for position trading. So we're not going to use these rules if we're day trading or if we're swing trading. Tonight's presentation is more focused on investing, doing 10 to 20 trades a year in your retirement portfolio, your RRSP, your 401k, whatever you are using, TFSA account, position trading, okay? So this is where we use the stock scores 3 rules. Sentiment stock score, we want that to be above 60. Signal stock score above 80. And we want a predictive chart pattern. So my first webinar a couple weeks ago, we talked about the 6 elements of chart patterns. We can combine those 6 elements to come up with these different predictive chart patterns. So one pattern is ascending triangle. It looks like that. Then you've got flag patterns, look like that. There's a whole bunch of different patterns. And I teach those patterns in the course material that are available on Stock Scores. All right, let's go back to the 2 examples we started tonight with. So first rule, sentiment stock score above 60. The sentiment stock score is the green line here. Okay, and you can see that it was above 60 there. It's hard to tell, but if you had looked at the stock on that day, you would have seen it was above 60. Second rule is the signal stock score, which is our blue line, which tends to be much jerkier. Okay, it needs to be above 80. And at point number 2, it was above 80. So we had above 60 and above 80. Now, when those 2 things happen, we want to look at the chart to see if it has a predictive chart pattern. Now, one of the patterns I just mentioned is something called an ascending triangle. It has a more or less flat top. It has rising bottoms. Volatility is diminishing over time. That shows that investors are getting confident. And then there's this burst of abnormal activity that breaks the stock through resistance from optimism, from low volatility with abnormal activity. We had also abnormal volume, and that started the stock into its upward trend. We have a scan on Stock Scores, one called the Stock Scores Simple. Okay, stock score simple, which I'll show you in a minute, that looks for this. And we'll actually do a scan together. We'll only be able to do it on the US market because the Canadian markets were closed today. But we'll do that in just a moment, and we'll look for some of those. Okay, but anyways, rule number 1, rule number 2, rule number 3, stock has gained quite considerably. Now let's go on to a longer term example. This is a weekly chart, remember? Okay, so it's not so short term. But again, we have our green line above 60, our blue line above 80, and we had a breakout through resistance from optimism, from low volatility with abnormal activity. And that stock has gone from $3.50 to $8.50. So better than a double. I don't know what's that, 125, 30% gain in 5 or 6 months. And it all started with our 3 rules being satisfied: the good stock scores and a predictive chart pattern. Incidentally, it had it back here as well. See that above 60, above 80, abnormal activity, and there it went on a little run as well. This time not quite as substantial, maybe 240 to 350, but if you go from $2.40 to $3.50 and you do that in 6 months, that is about a 45% gain. I'm just doing this quickly in my head. 45% gain in 6 months, that's beating the market. If we're going to be investing our own money, managing our own portfolio, that's the kind of trades we want to look for. Okay, if you can take the time to look for these on a daily basis using the process I'm going to show you in a moment, you can find these things. You just have to be patient for them. They come along in bursts, tend to be in bursts. We had a whole bunch of gold stocks that gave buy signals at the start of 2016. We had a bunch of oil stocks that gave good buy signals a few months ago. And it goes in spurts. And the next wave will be in another sector of the market. We just wait for it to happen. All right. So now let's talk about the process for finding trades. We're going to use the StockScores.com website in just a moment. A tool on there is called the Market Scan. You have to be a member of StockScores to use that. I'm going to show you one of my StockScores strategies. You have to be an investor student to see that. And we can focus this strategy on finding stocks that pay a yield or those that pay capital gain. Now I say the stocks that pay a yield because for a more conservative investor, let's say you're already retired, you're more interested in capital preservation and collecting a yield on your capital, we can put a little modifier into this market scan that searches for stocks that have yield. On the other hand, if you're younger, able to take maybe a little more risk, you want to focus more on capital gains, then we're going to more focus on stocks that are just going to move that maybe don't pay a yield. All right, so let's jump over to StockScores and do that now. I am in the StockScores website. Go to the market scan. We're going to select StockScores Simple Canada. We're not going to do. StockScores Simple US. Canadian market was closed today, so not much use in doing that. StockScores Simple US, and we'll run the report. Now, before I move on, I said here that you can modify this scan. I could say, show me all the stocks that pay a yield of at least 3%. Okay, so now I click on this pays dividend button. Now when I run the scan, I'm only going to get stocks that meet the rules of this strategy that also pay a yield. Okay, for my example tonight, I'm actually not going to do that. I'm just going to do the normal scan. So we'll just run the StockScores Simple Weekly US, run the scan, and it found 55 stocks that I have to check the chart of to see if they have a predictive chart pattern. So I'm going to say select all, and I'm going to view these in a gallery viewer. And as I go through these charts, I'm looking for a predictive chart pattern. Now, some of the things I want to avoid. I want to avoid stocks that have been trending higher for some time already. So this stock, for an example, has been going up since November. Okay, it's a great hold. No reason to sell this stock. It's in a nice upward trend. If you own Gold Standard Ventures Corp, GSV, on the Amex, hang on to it. No reason to sell it. However, it is going parabolic. The trend is going parabolic. That means that if I was to draw a line across the bottoms here, and sorry, I can't draw lines on these charts right now, but if I was to draw a line across there, you could see that the line is actually starting to curve to the upside. That shows investors are getting a little emotional. That usually comes at the point before a pullback in the market. All right, so as I go through these charts, I want to avoid the ones that are already been going up for a while. I want to find the ones that are fresh, that are just seem to be starting an upward trend, and I'm looking for certain patterns. Now, it takes some practice, but after doing this for a little while, you will know that there was a good pattern. It's what I call my bottom fishing pattern right here about the middle of March. Okay, stock gapped up, broke up from a rising bottom after breaking a downward trend line. I talk about this in my weekly newsletter all the time. The reversal pattern is step 1, break a downward trend. Step 2, build a rising bottom. Step 3, break from the rising bottom. That would be the day to buy the stock. Today it's been going up for 3 months. I'm not going to chase it here. All right. Now when you do this scan, you will get lots of stocks that are already going up. And the reason is because they're healthy. I mean, they're good stocks to hold. They have good stock scores. They're just not fresh good. We want stocks that are not only good, but just starting out their upward trend. So here's an example that's pretty good. Okay. This stock broke its downward trend in March. If I was to draw a line across these tops, I would see that it broke the downward trend in March, and it's been building the sideways trading pattern. It's something called a rectangle consolidation, and it broke that pattern today with pretty good volume. So that's a stock that looks likely to go higher. It's not perfect. It's going to run into resistance at $7, so the risk-reward ratio potential for it isn't great, and so I would only rate it a 7 out of 10. I don't love it. I like it. All right, so just take that as it is. All right, let's continue to cycle through these. Now I'm going to go through these pretty quickly. When you just start this process and you're learning, you would do this process much more slowly. I will be teaching people how to do this with a lot more detail in June. And in June when we do it, I do a nice little exercise where I make you assess the charts. We go through them a lot more slowly, and you determine whether a stock is worth considering or not. This one is pretty good right now. Traded huge volume today. It actually started its move about 6 or 7 days ago when it just made this little break here. Kind of a similar break to that AMKR that I showed you a moment ago. Now we're getting a continuation break, but I do think this one has got good potential to go higher. A few things that I'm not in love with. Some of these Chinese stocks, their accounting is sometimes a little bit suspect. This one's paying a yield of 10.4%, which to me is a cautionary thing because it's so high that I doubt that it can continue that. But nonetheless, notice the chart is good. It's above 60 on the sentiment stock score, or green line. It's above 80 on the signal line, and it's got a good chart pattern. So this is a decent one to consider, CYD on the New York Stock Exchange. I'd rate this one probably a 7.5 out of 10, a little better than the last one. All right, so I'm going to cycle through the rest of these, and I will stop if I see something that I want to talk about in more detail. Now the beauty of this tool is it's a great time saver. I can go through 55 charts so fast because I'm displaying them 10 per page. Now when you're learning, it's not a bad idea to look at these charts 1 per page. And we have another viewer for that. It's called the Slideshow Chart Viewer, where you can go through the charts one at a time, a lot bigger version of the chart, just to get a little bit more detail, do it more slowly. And for people that are learning in the first couple of months of learning how to invest with their own capital, taking control of their own money themselves, I recommend you use that larger chart. However, I've been doing this for a long time, so I'm going to go through them pretty quick. So we found 2 that I think are pretty good. I rated one as 7 out of 10, the other is 7.5. Novartis also looks pretty good. This is an ADR, which means it trades on a foreign market as well. ADR stands for American Depository Receipt. I believe it trades on one of the European exchanges. Not sure which one, maybe Frankfurt. And yeah, good chart, good traded, good volume today. Look at how the stock scores. The signal stock score spiked up to 98 today, had an above 60. We're at 64 on the sentiment, breaking from a rising bottom after recently breaking the downward trend line. Pays a yield, 3.08% historical yield. So that's the kind of stock you'd put in your portfolio, longer term trade, maybe one of 10, 15 stocks you might hold in your retirement portfolio. All right, so that's the process. Now we have different strategies. I did the Stock Score Simple. We also have the Stock Score Simple Weekly, which I did recently. There's a lot of different strategies. We have strategies for playing pullbacks to the trend line, strategies for reversing downward trends, something called a bottom fishing strategy. So there's a number of different ones. The components of a trading approach, first thing is you need knowledge. From knowledge, you can create a strategy. Knowledge also helps you know how to read charts. I can teach anyone how to read a chart to the point where you can analyze any stock in 10 seconds or less. To do so requires you understand 6 things. We talked about that a couple weeks ago in one of those webinars, but it takes practice, all right? Process, unless you find these on the day that they're happening or close to it or the week that they're happening, it doesn't do you much good to find them 2 months later. So you need a process to go through to find these things in a timely way. And process, I think, is as important as the strategy. Tools. When I started trading, I didn't have the tools that we have today. I ended up making my own tools, but I would spend hours and hours and hours to find a stock to trade. Now I can do that research process in 10 minutes because of the tools that I've made on StockScores. Having all of those things is nothing if you are a gambler. If you don't have emotional control and discipline, you won't succeed in the market. You need to have that discipline, have that control to play the rules, play your strategy, and do it properly. And of course, finally, you need capital. And capital, our number one goal when trading is to preserve our capital. If you don't have capital, you are out of the game. And so our number one goal is risk management. Don't take big losses. Preserve your capital. So how do you learn this? Well, I'll tell you how I learned it. I started out, as I said earlier, when I was 19 years old. There was very few books out on stock trading. You didn't have the internet like you have today with all these tools and out there. I spent 8 years trying to figure it out on my own. I paid a lot of expensive lessons, but I also did okay. I paid my way through university. And when I left university, I had aspirations of working in New York as an investment banker. Couldn't get a job in New York as an investment banker, so I kind of was dejected and decided that I would just continue to do what I had been doing through university, and that was trade stocks. And I stuck with it. At one point, maybe a year after I left school, I turned $30,000 into $500,000 in 3 months, and that built up my nest egg and really has allowed me to make a living trading the stock market. So that's how I did it. Over the past 15 years, I've been helping other people do it by teaching them my approach. I teach maybe 100 people per year. I don't make it my primary business. I don't do it often. I now teach a couple of times a year. But for me, it's a way to get away from my trading screen. When you trade every day, all the day, it gets to be a bit of monotonous like anything. And so I enjoy that time when I take a couple weeks where I teach other people to trade. And it's rewarding to have other people come back to me and say, hey, I earned 31% in the market last year and using your strategies. Thank you very much. I love those kind of email and I get those. So that's one of the things that I guess I can't get trading for money alone. And that's one of the reasons I do it. So last year we built the StockScores Education Center. And what we did in the StockScores Education Center is created modules, written, video, an assignment, and a test where you learn the theory. So that's called the foundation. And it's the theory, but you don't really learn the rules for buying and selling. Once you understand the foundation material, then you can start to use that foundation material for my strategies. And I've divided my strategies into 2 groups, investor strategies and active trader strategies. So investor is what we're talking about tonight. Active trader is what we'll talk about in Thursday's webinar. And again, there is a written lesson and a video explaining when to buy, when to sell, how to manage risk, and the process for identifying the opportunities. And that's all online. You can watch the videos as often as you like. You can take tests. You can make sure you understand. And as you work through that process, you have support from me. So when you do the foundation course, you're getting access to the foundation lessons. That's kind of your theoretical base. Once you understand that, and it probably takes, there's probably 8 hours of work to get through the foundation material, then you can start to understand the strategies. Now my strategies, which are taught in the investor and active trader area, I could write the rules on the back of a napkin. I mean, they're not complicated, but you have to understand my terminology to be able to understand the rules, and you don't understand the terminology until you've done the foundation. So when you take my investor course, you get access to the foundation, but you also get access to my strategies, and you get access to the tool that I built called the Market Scan. You get email support from me so that when you're doing the work and you're learning the material and you have a question, you just email me, and I'm pretty fast at answering email, typically within the day. I mean, I'm sitting in front of my screen trading all day, so I've got time to answer email, and most of my students, I think, would say that I'm pretty prompt at answering email. You also get access to our tool for 6 months free, which you can renew for $300 a year. As long as you want, you will have access to the tool as long as you pay that $300 a year. The Active Trader course, you get all of those things. You get the foundation. You get the foundation. You get the investor strategies, but you also get my Active Trader strategies, which are for day and swing trading. We'll talk about that on Thursday. You get support from me. You get my strategies. You also get my real-time indicators for TradeStation, which is a platform that you don't have to use, but it's a real powerful platform for day trading and swing trading. All right, now as I said, I'm doing some live training in June. So it starts off Saturday, June 4th. For 3 hours, we're going to do the foundation live course for Saturday morning. I'll just take you through the theory, and then Monday to Thursday of that week in the evening, we're going to do the market scans, just like we did tonight, except I make it a bit more of an exercise. We'll go through the market scan together slowly. I'll highlight why a stock is good, why another stock is not good. I'll get you to pick your winners, and we'll sort of, I'll ask the group, how many winners did you, or how many stocks would you buy out of the 30 we looked at? And it's always interesting if I look at, like tonight we looked at 55 and I liked 2. Typically when I do that exercise with my students, they like 5 out of 55. So one of my jobs as your teacher is to get you to be more fussy so that you only pick the 2 that are the right ones. And that's what we're going to practice that week, is really how to be fussy. Now, for those that do the Active Trader course, I'll actually trade live from Monday to Thursday in the morning for a few hours. I'll be trading slowly because I'm teaching as well. I will walk you through the process step by step for how I find day trades, how I find swing trades. The way it's going to work is on Monday, we're going to do what's called the simple swing strategy, which generates most of its picks in the first hour. So we'll do that for 2 hours on Monday. And then on Tuesday, we're going to do, what are we going to do again? I think my day trading strategies, the intraday pullback play, and the superheroes, which will be the first 2 hours of the day again. On Wednesday, we're going to do something called the wave strategy, focus on that one, for 2 hours, but starting a little later, from 7:30 till 9:30 Pacific time, 10:30 till 12:30 Eastern time. And then on Thursday, we'll do all of them. It's a lot to do at once, so I'll be kind of probably doing things quicker than I had previously in that week. But all of these sessions, whether you do the investor sessions or the Active Trader sessions, they're all recorded on video so that you can watch them again and again and again and just see the little things I do. It's basically like sitting next to me in my house watching me trade. I get so many people asking me, can I come watch you trade? Well, this is about as close as I do that, where I will share my screen with you as I walk through the process for finding these trades. Now, for anyone that registers for the Investor or Active Trader course before May 31st, will receive the Foundation Live class on Saturday and the strategy application Monday to Thursday for free. That'll be included. It's a $495 value. So again, there's the times. I don't need to rehash that. Course pricing, if you want to do the Investor course, it's $2,495. If you want to do the Active Trader course, it's $3,495. This is all Canadian dollars. For those of you that use US dollars, you're getting basically, I think it's about a 20-25% discount because it is in Canadian dollars. All right. So how to register? Very simple. You go to stockscores.com/learn and you can register there. What I want to do now is take your stock questions, and we're going to look at a few charts together. We'll do some analysis just so you can sort of get my thinking on how I do this. So now's a good time to type in your question. While I'm waiting for the questions to come in, I'll just launch the poll here. The poll basically says if you would like me to send you an email with some information about that class coming up in June, just say yes to what you're interested in, and I will send you an email. If you've already said yes, you're already on my list. You don't need to say yes again. For those of you that are my past student, I have already sent out those emails. So if you can't find it, let me know and I will send it again. I will be sending one more this week because I know a few people have overlooked it. And I will be sending another email this week as well for just the details about how to register for the class. Certainly, if you have any questions about the class, you can email me anytime. I'll be putting my email address up in a moment. While I'm waiting for the questions to come in, I will just take a couple questions. So one question is, when is the site going to be upgraded? So right now, my developers are upgrading StockScores so that it will be a responsive website. That means it'll work better on your phone, on your iPad. That's being done right now. They told me it would be done by June. My experience is that it never happens on time. So I'm thinking sometime in June it will be done. And I'm always pushing them to do it, but I'm a little bit at their mercy. So I'm just waiting for that to come together. Another question, what time frame do you use on the chart for position trading? So when I'm position trading, I use either the daily or weekly chart. And the answer depends on what strategy. For some of my daily strategies, I also use the 13 or 30-minute chart. Again, it depends on the strategy. So when you learn my strategies, each one talks about what time frame of chart to use. Another question. I will be looking at the stocks in just a moment, but I just want to answer some of these questions first. I can take this poll down now because I think it's all done. Thank you everyone for answering. And again, if you said yes to either course, I will be sending an email to you in the next week or so. There's my contact information. You can just write down my email address, my Twitter handle. Twitter's a great thing to follow for me on at StockScores on Twitter. I put out comments through the week on little things I'm seeing in the market. So, so another question, thoughts on the dollar exchange and only trading Canadian markets? So there's way more opportunities if you can trade the Canadian and US markets. But for Canadians, that adds in a risk of currency exchange. And there's also the transaction cost when you have Canadian dollars in your brokerage account and you buy a US listed stock. So I recommend that you either trade with a broker that gives you buying power in US dollars so you don't have to incur the currency exchange each way, or you just move money into US dollars and keep it in US dollars to buy and sell US stocks. Now, there are times when the Canadian market gives you lots of opportunity. In fact, in the last 3 or 4 months, well, actually, for most of this year, the Canadian market has given better opportunities than the US market because we've had, some action in the mining stocks, in the energy names. But previous to this year, for the previous 2 years, the Canadian market was kind of dead and underperforming the US market, so it was better to trade the US market. So I think you have to, be willing to trade either way, either side. I trade both. I just go where the action is. I don't care. To me, it's just a symbol. There's no other issues aside from the currency exchange. There's no other issues. It used to be that you couldn't buy US stocks in your retirement accounts. It's not really the case anymore. So I don't worry about that too much. What do you base rating a stock, and what rating do you consider investing? So I base my ratings when I was giving those stocks 7 out of 10, 8 out of 10. Well, I didn't give any an 8 out of 10. That's based on elements of chart patterns, and those are things that you have to learn. I teach that in the course material, and it takes some experience to get good at rating those things. When we do the live analysis next, in 2 weeks, I guess, starting June 6th, I'll walk through a little bit of the reasons why I would give a stock a 7 or an 8 or a 9. Generally, for me, I only consider buying a stock if it's a 7. I mentioned this concept of stop on close. So stop on close is basically the stock has to close on the time frame that I'm trading, has to close below my stop loss price. It's a manually executed stop. So if I say If the daily chart closes below $10, I will sell it the following day. If I'm trading off of the 13-minute chart, if the 13-minute candle closes below $10, I will sell it. And the reason I do that is because today high-frequency trading is a big force in the market. And on a lot of situations where there's a lack of liquidity, you'll get these stocks that'll just blip down really quick because the high-frequency traders are playing a little game to gun stops. And they'll take out all the stops and then the stock will go right back up again. It's kind of frustrating. I actually had it happen to me on Friday with Yahoo. The stock went down below my stop for less than a second. And in fact, you wouldn't have noticed it watching the chart because it happened so quickly. But it actually took my stop out on a stock that was highly liquid. It was the 6th most active stock on Friday's trading. And it's really just high frequency traders, either that or the trading desk of the brokerage that I trade with was gunning the stop. And I haven't figured out which one yet, but it's very frustrating. It ended up costing me some money, and it shouldn't happen, but it does happen. And so we unfortunately have to sort of change our rules. All right, so I'm going to look at some stocks now. Let me just go back to the Stock Scores website and pull up some of the stocks you've asked me about, and then we'll wrap up for the evening, and I will send out a video link for tonight's presentation. So the first one is CBYL, and I don't know why the chart's all wishy-washy over there. See if I can get it to center properly. That's weird. All right, well, just take it as it is. Doesn't matter if the chart's still there. I like this chart. It made a good break 5 days ago, pulled back. Let's just take a little shorter term view here. I'm going to take a look at the 15-day time frame. So it's very volatile. You have to understand that it's risky. To me, this support on the stock right now is at 82 cents. So if you're buying it here at $1.02, you've got 20 cents a share in risk. That's about 25% downside, which means you're going to buy less of it because it's a risky stock. Some stocks, to get the same amount of risk, you'd spend $20,000. On this one, you can probably get that amount of risk for $2,000 because it's such a volatile stock. If you own it, I think it's worth holding. Realize it's a very speculative trade, stock to trade on, but I like the chart. I think it's got more potential to go higher than lower. T.XAU. Something's really strange here with these charts not centering. Not sure why that is. This one doesn't have a lot of history, so it's a little bit hard for me to evaluate. Hasn't been trading very long, but it broke a flag pattern on Friday. Of course, markets were closed. Canadian market was closed today. So I think I like it. I don't have a lot of history to judge, but that little flag break is actually a good pattern. So worth considering. All right, how would you compare CVS and WBA? Let's take a look at CVS. And then I don't like that chart, and I'll then look at WBA, and then I'll explain why. I don't like either of these. So WBA has got falling tops. The sellers are in control. You can see the sentiment stock score is 39, so I would not consider that. CVS, excuse me. CVS actually broke down through support a couple days ago. The stock scores are still good because it's still got some upward momentum, but the fact that it broke that support, looks like Friday it did that, to me is a cautionary thing. Let me just look at the 3-year chart of this. Yeah, it's not as bad as WBA, but I think at best it goes sideways between 92 and 105, and it could actually roll over and break this long-term upward trend. It's very close to doing that. So I think you got to be cautious with that stock. Okay, I'll do 3 more. Next one is SPE on Toronto. So Toronto symbols have to have a prefix, so T.SPE. Oh, that's not coming up. Maybe it's the Venture, SPE on the Venture, which is V.SPE. There it is. However, it's not coming up there either. So I don't know if the symbol is wrong. Spartan Energy, yeah, it's for some reason not coming up. Ah, there it is. Move to Toronto. Why it didn't come up the first time, I don't know. Must have typed the symbol in wrong. All right, so what do I think of this one? Initial thought is it's good hold. I don't think I would buy it here because it's coming into some resistance. It's got some upward momentum. That's a positive. I think it's going to get stuck between 320 and 340. So the upside is kind of limited in the short term, but if you have patience with it longer term, as long as that upward trend line remains intact, I would stick with it. As I said, though, I don't think I would initiate a position here. If you own it already, stick with it. NTRA had a good abnormal move today. This is a sort of cup and handle pattern. I'd give this one a 6.5 out of 10. How's that mic working now? Testing. Is my voice back? Looks like it might have come back. Okay, good. So sorry, I don't know how much of that you missed, but it wasn't that important. I was just basically saying that that last stock, which I'll bring back up here, it's an okay stock. I don't love it here to buy it. I think if you own it, I would stick with it because it is doing some positive things today, breaking through resistance. But I think there's quite a bit of risk in this one because it's been going up for a while already. So I wouldn't buy it here, but good hold. All right, so there's my contact information. Sorry that I dropped my sound there for a little bit, but hopefully I didn't miss too much. I want to thank you all for joining me tonight, and we'll wrap it up there. There's my YouTube channel. Give that a look. Lots of free stuff. All these webinars are uploaded to YouTube. @StockScores is my Twitter handle. And hopefully everyone can join me on Thursday, another webinar on Thursday, same time, same place. We'll be looking at active trading on Thursday, just again walking through the processes and that sort of thing. And if you have any questions about the upcoming class, certainly email me. There's my email address, tylerb@stockscores.com. You can also just go to the Learn page on StockScores and register there. Thank you all. Have a great night, and I will see you Thursday.